When I pass away, my wife wouldn't get the death benefit and the cash.
Oh, wait, what does she get?
She gets one or the other, whichever one is higher.
Wait, really?
Debunked.
Right?
Yo, a lot of people don't know that.
Yeah, I actually never knew that.
A lot of people don't know that.
So you, wow.
What's up, Back Talk family? Today we're sitting with an expert, Joe Catanzarite. This guy actually helped me because I was about to get into a life insurance policy that would have ruined me financially. But luckily I got on the phone with Joe and he literally saved my life with that. No pun intended. So I think that it's time that he saves your life, family. I'm glad we can have this conversation with him. Thank you for sitting with us.
Thanks for having me.
Most definitely. Nooska, you want to say anything?
Yeah, so I'm excited for sure because I know I've had a lot of conversations on life insurance actually. Sure. And I'm ready to learn a lot because I'm pretty sure we will learn, right?
Yeah, he's going to debunk every myth.
Exactly. So I heard a lot of good things about you, bro. Let's just dive in by first talking about yourself and how you got into everything.
Sure. Well, my name is Joe Catanzarite. Actually, I met Rel through somebody I used to train years and years ago. So, one of the biggest things of being in the business we are is referrals, right? Mm-hmm. As I'm sure we were just kind of talking about. And, we stayed in touch a few times over the years, and it was kind of right time in your life and kind of right timing, right? I'm a big believer everything happens for a reason. Made the phone call, we were touching base, right, and just kind of showed him something that I believe in personally,
right,
and which everybody should have. And but I really got into the industry. I know you guys are big in the finance for years and years. that wasn't my story. I was a sports guy, soccer coach. Just was kind of looking for something a little bit different at that time, and kind of transitioned. I had a family member that was in the business, and I figured why not learn, give it a shot, and see where it goes. And now this is where we are years later.
That's perfect. That's perfect. All right, so I guess the first question, right? Let's just start off by saying, what is life insurance? Right? Like, why is it important? Why do people need it? Okay. And I think that is a question that we always, pondered, but we never really found an answer to because so many things are different on Google. Sure. So let's just break it down.
Sure. Life insurance is important for a few different reasons. The main reason and the biggest thing is I like to call it income protection, right? Because you can't replace a life, right, but you have to replace the income that life provides if somebody's depending on your income. And that's the biggest thing about life insurance is that it's for protection of your income. If somebody's married, has young children, there's responsibilities, things like that if something happened to them and their life was not, if they weren't here anymore, how would that family member that's left behind be financially okay? That's really what life insurance is for.
Gotcha.
Just kind of like car insurance, right? You hope you don't use it, right? Mm-hmm. But it's there in case.
Got it.
Nah, literally. I mean, what I've heard about life insurance is like it can help people build generational wealth. Like, a lot of people, especially in communities where, maybe crime is high or something, and then a lot of lives get taken. But like you said, incomes are not replaced. So that's just literally destroying families. And so I'm so glad we had this conversation because we know how important it is to replace that income. So let's talk different types of policies, right? Because life insurance, it's not just one thing. There's different ways to do life insurance. So could you explain the difference between, like, let's say whole life, term life, universal,
Sure. Yeah, so there's a few different, there's like two main categories, right? And one is really considered a cash value, right? And now cash value can be broken down into a few different things. It could be whole life insurance, right? Universal life insurance, variable life insurance, index universal life insurance. And all of those are similar in ways, but also have some differences too. The main similarity is that there is a cash value component attached to the death benefit, right? So if somebody passes away, there's a death benefit, and then there's a cash savings value attached to it.
Okay.
The other main category is term insurance. It is strictly insurance. There's really no anything else to it that you could add, like riders and little things in between there. You could have it increase, decrease, level term, right? And I'm a big proponent of level term. But the main two categories is that cash value side, and then there's that term insurance side.
So when we say term, right? Because I know when I was first starting off, I had no idea what that meant. Like when you say term, what exactly is a length of time that you're going to have the insurance for, and like how many years and how many different policies are there for a term? Is it just one policy, like 5-year term, or can it be like 30-year term? Like can you talk about that?
Sure. So you can do 5-year, 10, 15, 20, 25, 30. Outside New York, you could do 35. Right, so there's always nice benefits of other ways of being outside New York. Yes,
we've been talking about that for a while.
New York keeps doing bad, yo. New York, bro, we gonna have to talk.
I think we have to talk to the governor. Give us a call back. So I think about to get banned on YouTube now.
Yeah, probably. But if we leave New York, we could get an extra 5 years on that. On the life insurance, and I'm definitely for leaving New York. Outside of that, but that's another conversation for another day.
Definitely.
But yeah, so you can get different terms, you can get different lengths, and then you can get, like if you have a 20-year term and then need a term after, right? You can get a term again, right?
So you get multiple terms even after your first policy is finished.
Correct. Yes. Now obviously, the benefit of having a longer term is our health is guaranteed when we're younger, right? It's less expensive, things like that, but you can carry term insurance until you're age 95 if you really had to.
Wow. I didn't know that. And does it get more expensive?
Yes, definitely gets more expensive, just like anything, right? And how the insurance company looks at it is, right, if I'm 95 or I'm 35, when am I most likely going to die?
The 95.
When I'm closer to 95, right? So if I'm closer to death, I'm more of a risk to the insurance company, so they're going to charge me more because they know they're going to pay out more likely.
And it makes sense. It kind of like follows suit with other things. Like if we're talking about a car, like if your car is older, your insurance is going to be higher than if you're driving something newer. That makes a lot of sense. And it's funny, you were talking about age, and so a lot of our listeners we know are like on the younger side. Shout out to the older listeners, we love y'all too. And everybody needs the information, but for my younger listeners, like, do they need life insurance now, or that's something they could wait on? Like, all right, I'm probably not going to die now, knock on wood, but it's like, do I really need it?
Sure. So to your point right there, right? I'm probably not going to die. And now that's like one of the biggest things, right? Because we're all young, somewhat young, right? And depending where we are, but nobody ever thinks they're going to die tomorrow. But can we guarantee that? Now, some people will sit down and say, "Hey, you have life, you need life insurance." That's not something I believe in, right? So I'm sure there's a few of you are saying, "Hey, I'm 18, I'm 19, whatever it is, I don't need life insurance," and you could be right. And the biggest thing is if there's somebody that depends on your income, right? We were just talking about moving out of New York. Well, in New York, most people are usually settling down, having families, maybe their late 20s, right? Buying a house in their late 20s, 30s, hopefully, right? New York prices are going up, so maybe that takes a little bit longer. But if there's and I'll use myself as an example because I think that's important, right? I have a son, I have a house, I have a wife. She stays at home. If I'm bringing in an income and something happens to me, God forbid, on the way home, right? Is this wood?
Yeah.
Right? Exactly. So if something happens to me on the way home and there's no more income coming in, how can they survive financially? Right?
Yeah.
Now, back to your point with the age is, well, I don't know, Alabama, right? They might be getting married 19, 20. If they have somebody depending on their income, there's a need for life insurance, right? Because without that income, their financial future is changed. If they own a home, whatever it is. And then as far as age, I guess not the only, but the other kicker sometimes is where people go, "Oh, I'm not getting married until I'm 30," and when there could be a need for life insurance at a young age, is you guys went to college, right?
Yep.
Right. Did you take out student loans?
Yep.
Did your parents co-sign?
Yep.
Right. If God forbid something happened to you, were they prepared to pay the rest of the student loans?
I would hope so.
Right.
So I would hope so.
You would hope so, right? But if they're not, there could be that need for, hey, you know what? I want to get a small policy, $20 a month, $150,000 of coverage, so my parents don't have to pay for my schooling. Right. So that's where you could say the need at a young age could be.
So I guess on that part, right? Because you just mentioned money, and I know that you said $20 a month can get you, let's just hypothetically speaking, $150. So explain how that works. Like, how much typically would you be expected to pay if you're, what are our listeners, 25 to usually 40? Let's just say you're like a 30-year-old person, you're pretty healthy, and you have an income right now. Let's just say would you suggest they go term life, or would you suggest they go whole life if they're looking for a cheap life insurance?
Okay. So if they're looking for cheap life insurance, and I like to use the word cheap, I like to use the word value. Best value.
Okay.
Right? The cost of term insurance is always going to be less expensive. Depending on their age and their health status, at least 4 to 5 times less expensive. Sometimes you'll see, depending on the companies, could be 15 to 20 times less expensive.
Wow.
So there is a huge difference in cost.
15 to 20?
That's
Of course,
crazy.
yeah.
That's crazy.
And you'll see, and I can kind of show you some examples, as well, and why there's such a big difference, and because of components, right? Whenever there's something less expensive, there's a reason as well, and we can get into that. But term insurance is always going to be less expensive, unless you're 75 years old and somebody got whole life insurance when they were 22.
Got it.
Something like that, because health and age is two of the biggest factors when it comes to life insurance.
Got it.
And I think a person is at risk to, waiting. You know how you used to wait to have, you kind of wait to have somebody depending on your income, right?
Yep.
Now, the only risk in that, I would say to the listeners, is just that you don't know what your health could do.
Yep.
People come down with illnesses at all time, at any time. Nobody expects to get, cancer or whatever it might be, knock on wood once again. So it's just always keep that in the back of your head, I would say, because then you're going to pay a higher premium if you want to get life insurance after you get the illness.
Yeah, of course.
I would just add that in. But now I know people, we said build generational wealth with life insurance. So that's because they try to invest it there, right? So could you talk about, I know you said there was a cash value attached to even whole life or universals and stuff like that. So you want to just break down how that works?
Sure. Yeah, so the two biggest things is in like a cash value policy is, right, there is a death benefit, and then there's that cash value. So people use it to build wealth, right? And I'm gonna do quotes, right, because everybody has a different meaning on wealth. But I am not a believer of that. I am a believer 100% in term insurance and investing your savings, investing the rest outside of insurance. And I'll kind of show you a few examples and things like that. But as far as whole life and the really how it gets packaged is very simple, right? It's part of the money that you pay, right? You were asking about the cost of it before.
Right.
30-year-old, I don't know, and we live in New York.
Yep.
Right? So maybe I'll ask you guys this, right? How much life insurance coverage would you think that, say, a family would need, or an individual if they had a family living at home?
At least 100K.
Okay.
I feel like at least, to handle everything between funeral costs and then cost of living for another, let's say, year.
Okay. What about you?
I was going way north of that.
Okay.
Because I'm thinking more so if I have this is assuming you're married or single.
Married, have a family.
If I'm married and I have kids and a family, and I gotta take care of bad talk, you know what I'm saying?
True.
You gotta give love to our listeners. I would honestly think, am I crazy to say $1 million?
Not at all.
I would could think about it insurance. Obviously, it has to be there to protect your family, right? Funeral, yes, but what about kids' education? What about your wife? She's doing her own thing, and then you need to bring in other income. Your parents, her parent, I don't know. Am I crazy?
No. So in kind of both the answers, not to be right politically, right? But both of you were correct in an area, right? And I would say you're correct if we're talking about a family.
Yeah.
You're correct if we're talking about that student loans, had 100,000 funeral costs, something debts like that.
Yeah.
For example, if I passed away tomorrow, 100,000 is doing nothing for my wife. Right?
Sure.
She's not even covering the mortgage. Right? Because that's reality.
That's what I was thinking.
Yep. So now you said about $1 million. Now $1 million, right? If I have $1 million, all right, covers the mortgage. My son could still go to college. She could stay up on her feet. But now she's got to go back to work, figure out daycare. So there's two ways that I like to teach people of how much, because that question comes up all the time. How much should I have? What do I need, right? And now when I sit down with people, I like to go through all of their finances. I want to put a budget together for them. I want to put a whole financial plan together for them, because sometimes they don't even know what they have or at home and how much debts they have. So we want to find that out, because the two approaches you want to look at is, one is called the DIME approach, D-I-M-E, right? DIME, right? I'd rather have a quarter, but we got to start small, right? But the DIME approach is you want to cover your debts, You want to cover your income, you want to cover the mortgage, and you want to cover expenses or educational expenses for the kids, right? So you want to make sure those. So if your mortgage is $500,000 and your spouse doesn't work, well then how can they pay that mortgage without my income or without your income? So they need at least that covered, right? Plus income, plus other debts, credit cards, student loans, things like that, because that falls on the spouse or the partner or the children, right? Depending on the loan. The other way, general rule of thumb is like 8 to 10 times your annual income. So if somebody's making $100,000 a year, 10 times their income is $1 million. Mm-hmm. Right? That's kind of those are like two common threads to kind of use to build that.
Got it. So the first thing, I don't know if you have a question real quick, but basically I'm just thinking out loud, right? So right now, let's just say that you said invest the difference when it comes to term. So you're a component of use term life, but then invest the difference with whatever it is. So when you say that difference, how does that number come about, right? Like, are you investing the difference between whole life and term? Like that price difference? Or like what do you mean by the difference?
So great. Yeah. So, because that goes back to your question before, Rel, right? Is really, so let's say for like a 35-year-old, and I'll use a basic example, right? Like a 35-year-old that is looking at life insurance. Now we were talking about how much coverage somebody needs, right? So let's just say they're not looking at $1 million of coverage, but they're looking at $500,000 of coverage, right? So whole life insurance is more expensive. Why is it more expensive? Because there is a cash savings account attached to it, right? So when if I take my money, I put money into it, some of the money goes towards the death benefit. So if I pass away, my family gets paid, right? And some of the money goes towards the cash value savings, okay? Now, how much goes towards each? They usually can't tell you that, right? And
the company.
Correct.
That's funny.
Right? The policy. So you could ask those questions. 99% of agents won't be able to tell you. They'd have to dig through contracts, go through cost of insurance, blah, 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 all these different things. But on a general rule of thumb, about $500,000 of coverage for an average male, right? Non-smoker, right? Smoking raises, right?
Of course.
Tobacco or nicotine, right? So for everybody, just that's the biggest kicker. But you would realistically think about $500 a month for a $500,000 whole life insurance policy.
It's a lot of money.
It's a lot of money. Now, why is it more? Again, that savings component to it, right?
Yeah.
And because there's two parts, right? If you're getting two things,
you're paying more.
Right, so some of that money goes towards that. The problem, and sometimes with whole life insurance, and I don't know if you want me to.
Of course, no. Okay. Dive in.
Perfect. Right. So
debunk, man.
All right. So the issue with whole life insurance is that you get a low interest rate on your cash savings.
I was literally about to ask that question next.
Perfect. Right, because you guys know money.
Yeah.
Right, and if I just said right now, hey, what's the S&P get regularly?
On an average, 10%.
10%. So if you were getting 4% or 3%, would you rather get 10 or would you rather get 4?
10. What do you think, Backtalk?
Thanks, so y'all better know that too.
There you go, right? So would you rather have an extra 6% basically, right? So that's where, don't have your money saved up in that type of plan. The other thing for that is if I pass away, now I'm paying for two things. And this is one of the biggest myths, right? And now if we research it and you ask these questions, it's just if we know nothing about life insurance, how do we know what questions to ask? Mm-hmm. So when I pass away, my wife wouldn't get the death benefit and the cash.
Oh, wait, what does she get?
She gets one or the other, whichever one is higher.
Wait, really?
Debunked.
Right?
Yo, a lot of people don't know that.
Yeah, I actually never knew that.
A lot of people don't know that.
So you wow, that kind of just shocked me a little bit.
Yep. So
I'm learning with y'all.
Yeah, there you go. And that's why I'm a big proponent. Read contracts, right? Because it'll say it in the contract, right? Upon the death of Joe Catanzarite, right? And this is like the third time I've killed myself on the show.
God forbid.
Right?
We're not trying to get my man's out of here.
Right, but I don't want to kill anybody else off, right? So if it's here, right? My wife is covered, thankfully, right? So but in the contract, it'll say, upon death, you will receive either the death benefit or the cash value, whichever is of greater value. So if the cash value eventually grew to, say, $600,000, which in a whole life insurance policy, it would take like 90 something years to do that. And that's where the numbers, and they give you tables and you can read the tables. And that's important, right? Read the numbers. Math doesn't lie. But if the coverage was 500,000 and the cash value was 400,000, and I die, my wife gets the 500, the company takes back the 400.
So people thought they were getting 900 in that scenario.
Most
people thought,
yeah.
But really you're only getting one of the above, like one or the other. That's crazy.
And that's how every cash value policy works.
So I guess like on that piece, because you said you're paying $500 a month, obviously because you're getting two things, but I guess a silly question might be, how long do you pay that for? Because if it's a whole life, right? Are you like paying that until you die, or
you
like
pay it your whole life? Right?
So until you literally are,
or you decide to cancel the policy.
So you can
cancel the policy. And now certain policies, like universal policies, they have surrender charges. So like say you think you have money in it, but it's year 8 in the policy, they might charge you $12,000 to just cancel the policy. And if you have $20,000 in the cash, now you're only receiving 8. Right, 20,000 minus the 12,000 surrender charge, you only get 8 back.
But you would have made more if you just put that into the market.
Correct, right, and you can, right, and that's where I don't like locking up my money, right, and I'll ask you guys this, right, if you're investing your money, do you want to be in control of your own money, or do you want somebody else to control it?
No, I mean,
you want to control it, right?
100%.
Right.
Yeah,
so
definitely.
if you need it, you can take it. If it's your money, take it, right? And how cash value policies work, there's 2 ways to get the cash, right? So whole life, universal, variable life, index universal life, those are all forms of cash value. The only way to get the cash value is 2 ways. You could borrow it, right? But whenever you borrow anything, what do you always have to do?
Pay it back
with
Pay
interest.
it back with interest. Usually 6 to 8% interest.
So more than you're actually receiving.
In a whole life policy, you
Right.
could make a little bit more interest in a universal there, right? But there's high fees. There's and you'll see in the contract there's fees that will kind of eat at that interest rate and that percentage. So you might get 6%, maybe you get 7%, but if you borrow it and then you have to pay it back, is it really your money anyway?
No.
So it's funny, like a lot of our listeners, because we put out a poll on our page, and those of you that follow the page, which you should, at the Bag Talk Show on Instagram, we put out a poll and it had people saying, do you prefer whole life, term life, or like a VUL, IUL? And some people were hitting our DMs saying like, oh, VUL, IUL all the way. And so first, can you please just explain briefly like what a VUL is, what an IUL is, and then why you still think term is better than both of those?
Sure.
Term and invested difference.
So IUL, right, Index Universal Life Insurance Policy, is a form of the cash value. It is a death benefit life insurance, and then it has an investment component in that cash value that is invested to the indexes, right? The S&P 500s, right? The Russell 2000, those type of investments. The same things that you guys talk about on your show all the time, right? But you talk about it separate, not attached, right? Yeah. So now if you're investing, let's just say you're investing in the S&P 500 and you're making 10%, well, you could invest in an index like that, similar in a IUL, but then with those fees and everything there, that 10% is not going to be there.
It's really like 6% because it's eating away or whatever.
It depends on the market, right? Because it's a
right.
market fluctuation. Nothing's guaranteed, right? It's a market fluctuation. So you never want. Anytime they use the word guaranteed, be careful. In a universal whole life, that insurance, that is guaranteed, but it's guaranteed to keep you broke because it's only at 3%, and inflation is about 3%. Right now it's higher, but national average, right? So the index universal, that savings component is invested into indexes, right? So now you could borrow again from that cash value, but you have to pay it back, right? If I pass away, my wife gets the death benefit, the company takes back the cash. The only time ever, right, and I'll emphasize that you get both in a cash value policy, the death benefit and the cash is when you add an additional rider called a universal. It's called a universal B rider, right? The option B. It's an extra cost. It's usually almost the same price or double what the actual policy costs. But that's the only time in any form of cash value policy that you will get both the death benefit and the cash.
And you pay more, as you said, for that.
You would pay more, yeah. So say your policy is $500, you might now be paying $850, right, for that. So that that's where that. Now you could say, well, at least I get both, right? Right. To that. Then back to your question was, what's the difference from a variable life insurance, index universal, or just universal? Universal and indexes are attached to indexes. Very simple. Yeah. Universal life insurances could be whatever, right? Mutual funds and different options of investing that they have in that side. But the same concepts apply to it. There's fees right there. They won't tell us what's exactly going into it. So we might be getting 8-9%, but 8-10% of what amount? Right? We don't know. Hey, is $300 going to that? Is $200? Is $400? We have no idea.
So it's like if my policy costs $800 a month, for example, right, and that means they might invest really 500 of it. You're saying that'll really go to my cash value, and the other 300 the company's keeping. Like,
say that again. I'm sorry.
So like, say I'm paying $800 a month for my VUL.
Yep.
My variable universal life insurance. Then the company, what they do with that 800 is they might take 500 and invest that for me, and then 300 goes towards the insurance company themselves. You're saying? Yeah.
So with a variable life, so how it's an interesting thing, right? Universal life insurance didn't come out until the late 70s, right? Whole life insurance has been around centuries, years and years, right? 1800s. Why? Because it was very simple, right? They used to give better rates of returns back in the day, just like banks used to give better rates, right? When our grandparents around, banks were giving like 3% or even more. Now
that's when savings accounts were actually worth it.
Exactly, right? Now it's 0.003%, right? We lose money keeping it in the bank, right? So we have to be invested. It's the only way to grow money is to have it invested, especially for people around our age. So to that question is what universal really is. It is a form. Is what they did is when the buy term invest the difference. I guess you could say crusade came out. Is they created a policy called a universal life insurance policy that would kind of counteract both and try to go against the whole life and make it a better investment, but go against the term insurance where there was an investment. Right. Okay. So what universal policy life insurance really is that there is it is really an annual renewable term policy. And what that means is, right, it's a term policy. Every single year it renews at our new age. So if I'm 30 years old, right, and now next year I'm 31, then I'm 32, 33, 45, 50, 60. Does insurance get more expensive or less expensive?
It gets more expensive,
More expensive, correct. So now what the universal policy doesn't do, and this is the biggest kicker, right? And this is what most agents will not tell you, but where you want to look at a contract, and I could even show you and have it on here, is when you look at, so as the cost of the insurance goes up, the premium that you pay monthly, they're not going to charge more for. What they're going to do is start taking money from your investment.
As a fee?
To cover the difference of what the cost of the policy should really be.
Oh, wow.
Yeah.
Okay, got
it. So if I'm 30, but now in 10 years I'm 40, my insurance is going to cost more because they're renewing it every year at my new age. Okay, so now I'm 10 years old and my policy that, hey, it cost $150 10 years ago is really maybe $250 now. They're not going to charge me an extra $100 and I'm going to send them a check every month. What they're going to do is start using my savings and investments attached to the policy to cover the difference. So now as I was growing money, now what starts to happen is I continue to get older, my insurance continues to get more expensive. They start using that cash value savings, that investments to cover the cost, and now my investments start to go down. And there's always a section in every single policy where you'll see that split, right? And if you see here, I have an example on here. This is an example, and it's an old example. I obviously have names and companies and everything blocked out. But what it actually shows you on here is No, this is a $1.5 million policy, right? So you're not off with $1 million, right? Okay.
Thank you.
Right? You're welcome, right? So now this was a young male, 36 years old, non-tobacco. This is actually a preferred rating, right? So there's different ratings: preferred plus, which is like super healthy, right? Then there's preferred, which is pretty good healthy. Then there's like standard, like you're a normal guy or gal, right?
Yeah.
This is preferred. Now this costs $750 a month. It's universal, so there's the policy and there's the cash component to it. And what happens is, as you see, so now if you're paying $750 a month, that's how much is that a year?
That's 70,
75,
80. Yeah, about 87 on that.
It's $9,000 a year
Yeah.
that we're paying into this policy. And the crazy thing with cash value policies is the first 1 to 3 years, if you look at what's in the cash value, there's $0 in the account.
Like, why is that exactly?
Because a lot of times it's front loaded to pay for upfront premium, and it hasn't had enough time to grow the investment yet.
But they don't tell you that up front, or do
Depends on the person.
They
It
might.
depends. I'm never gonna say like, they sold it intentionally, because sometimes they don't know, and companies make a profit when agents come in and just sell policies, right? But if you look at your cash value, like I always ask the question, if you went to the bank and you were putting $750 a month into the bank for 2 years, and you went to the bank and said, hey, I want some of that money, and they told you there was nothing there yet, would you ever go to that bank?
Absolutely not.
Absolutely not,
Absolutely
right?
not.
But that's how most cash value policies work for the first 3 years. There's nothing in the account for you to borrow, or take out until it starts growing more.
Wow.
Okay? So, and then you see here is year 10. Right now, I've paid $9,000 per year for 10 years. That's $90,000. Now, you guys are investing guys.
Yeah.
Exactly. If I
Right.
put 90,000 in any market, I'll be happy. But you're really throwing it to the insurance company right now.
A lot of it, and you see there, right, the cash value, right, if you look at the cash value, it's at $35,000. Right, so if you put in 90,000 and they gave you back 35, would you say that's a good investment?
Absolutely not.
Absolutely not.
Absolutely
Come
not.
on now.
We always say on the show, like, we're investors, we're not traders. So, like, if we're putting our money to use, like, we're saying, yo, I'm investing my money here, it better work for us. And if it's not working for us, we're not doing it.
Mm-hmm. Exactly. And what then they say is, hey, you just got to wait a little longer. Trust me. Just investing takes time, right? And I say, okay, great. Let's go another 10 years. Now you put in $180,000, right? Let's look at the cash value. It says it right here, right now. The biggest thing is you see here, year 19 there was $71,000 in, but year 20 there's $69,000.
Oh my God.
I was ticking backwards.
Right? Yeah, it's going backwards.
Yeah.
Why? Because the cost of insurance
It's going up.
And
they have to the difference.
They have to cover that difference, right? And it tells you right in the contract. You actually see the words here, right? The policy will lapse. What does that mean? The policy will implode. It cannot stay in force because there will be not enough money in the cash value. And you actually see where it shows $0. At age 65, they'll have $0 in the cash investment. Now, it was sold as life insurance and an investment, right? But what happens is if they have to continue paying more and using that investment, the insurance continues to get too expensive, and there's no way to continue paying. So the policy will lapse unless I now want to pay for, I don't know, $1,800 a month for the same amount of life insurance because now I'm 60-something years old.
Wow.
Yeah,
So
crazy.
in that case, it all comes back to it, right? Like, that's why if you said this was 35, right? For this example?
Yeah, it's 35, 36.
And you said, how much was it, 750 you said, or 700 a month?
Yep, 750.
750. So for someone, this example, right? If they did term, how much would that, like, as an estimate, you think go for? If they did 30-year term.
30-year term, they're doing a 1.5 million. Let's just round it up and say $150 a month.
I was gonna say max 200.
Yeah, say max 200.
Let's just say that. So that's $550
Yep.
that you can invest. So if we do that, we always say it, right? If you do $500 a month, that's $6,000 a year. Your IRA is set, and you can pick your own stuff for your IRA, right? We always say that.
You could invest in the same things they would have invested you into.
Better,
or even better.
To be honest, better,
Yeah.
right? So if you do that, and let's just say this is a whole life. So Mr. Math here, let's just say 30 years. What do you get on that? 180?
180, yeah.
Yeah, so 180K principal invested at 10% average, you're hitting north of 900,000 probably.
Oh, yeah, easily.
right.
Well, we got visual on the screen. So
Yeah, I don't know what it is. I'm just
Perfect.
saying you're hitting a pretty good number on that. On top of you're still having term. So that means you're still covered.
100%.
That's amazing.
100%.
So what I like about that, and this is actually full transparency, what Joe told me when I had that conversation with him that day, it literally saved me from signing on something that would have depleted me financially. But he told me, like, because I'm an investor, as we all know, that's why we have the show. So I'm thinking, like, is this a good investment? I'm about to get into a VUL at the time. And then he's like, yo, listen, man, term, if you get term now, just like we have cars, right, that you have to pay for your insurance just in case something happens. Your wealth might not be exactly where you want it yet to where all your family be sustained. So if anything, it's like getting term up front covers you, so your family will 100% get, let's say, for example, $1 million. Your family will have $1 million if you, God forbid, pass away between now and, let's say, 30 years from now.
Yep.
30 years from now, I'm going to be, what, 56?
You're not 15 right now?
Keep it up. Yo, he gets a beard. You see that? He gets one beard and think stop, bro. I'm not even going to say that. Yeah, his birthday was yesterday, by the way.
Oh, that's crazy.
At the time of
That's crazy.
I feel you. He's old now. But anyways, but like, so I'm covered for those first 30 years, right? Like, my family would get $1 million. Now, if I'm also investing during those 30 years, we just said 30 years putting $500 a month towards my investments. I'm most likely to be a millionaire. I can't wait till we get the visual.
Yeah, I don't know the exact math on that, but I'm pretty sure you're going to be north of $1 million.
Yeah, you know what? I mean, listen, I'll show you something. I actually put something together to kind of show you, because you said it there, right? And term insurance, right? Again, we don't use it, and your goal is not to die, right? It's there to protect us in case something happens. Right, and one of the biggest things is, the life insurance companies will come out and say, oh, well, 99% of term policies don't get paid out. Well, yeah,
that's a good thing.
Yeah, exactly. That's a great thing, right? That means I didn't die. I'm still around. I've been investing for 30, 40, 50 years. The goal is not to die. You're not going to get mad because you didn't use your car insurance this year, right?
Mm-hmm.
Right. It's there in case you get in a car accident. Right, you're not going to get pissed that you didn't have your house burnt down this year, and oh man, I really wanted to use my homeowners insurance this year. Right? Same thing. I'm not going to be mad that I didn't use my life insurance. I'm thankful. I want to pay as little as possible to protect my family, because tomorrow is not promised.
So I have a quick question on that, right? Because it just sparked me. I don't know if this is how this works, but like, say that I have life insurance, it's term life insurance. Would you recommend that, my wife also gets life insurance, say I'm married, or would you just be like, or can I add her to my pot? Like, I don't know how that works.
Great question. So if you guys are living, right, married, living together, you should both have it, right? And now if it's to replace an income, it kind of goes back to that dime approach, or 8 to 10 times your annual income. Now, there's the certain, questions that come up. Oh, well, my husband or my wife is a stay-at-home mom, stay-at-home dad, whatever it is. They don't need life insurance. And I understand where they're coming from when they're saying, well, they don't bring in an income, right? Well, if your spouse doesn't bring an income, doesn't mean they don't bring a value. Right? Without my wife taking care of my son, taking care of the house, doing everything, and let me tell you that what she does is absolutely amazing. And
brownie points right now for this man.
There you go. She might watch this. We'll see. Right? But without her taking care of everything else, I wouldn't be able to go make the income I can. Right? So without her at home, that is a huge value. That's not undervalued. My son would have to go to daycare. But I'd have to hire someone to cook, hire someone to clean, right? Because I'm not doing those things and have the time to maybe do it, right? So there's a value. So they still need life insurance. Now, I don't have as much for her as I have for myself, right? So to your point, but you should have it together.
And can say that, like, just to this part, you can't have I think you said for the universal or like the different types of life insurances, you can add someone, but for term, you can't add someone. Like, I can't add my wife to my insurance.
Oh, no,
right?
you can.
Oh, you can?
So me and my wife are on the same policy.
Okay.
And you should always do that. Why? One, there's every policy, every life insurance, all types, have a policy fee, right? It's like $75 a year, right? Because that's like the paperwork, all the stuff that the companies need. So they charge, $6 a month. So why would you have 5 policies and pay $30 a month? That's $6, right? Or when you could have one.
And no matter, like, God forbid, like, one of you passes away, it still gets paid out.
Correct.
You know,
Yep.
like,
So if my wife passes away, I get her death benefit.
Right.
If I pass away, she gets my death benefit.
Yeah,
We're
I
just
don't
on the
think
same
so.
policy.
I don't think it's even a question at this point. I'm term.
Like
Like
term and
100%.
invested difference. Term because I want to highlight that too. It's not just term. It's term and invested difference. I need the audience to understand that. Because if you're not investing the difference, then you might as well go with.
I would say whole life. You
Yeah.
know, like, and that's a huge point, and I'm glad you guys brought that up because I was going to forget about it. Right? It is. You're not comparing when you compare life insurances. Sometimes you're not comparing apples to apples, right? It's apples to oranges. Now, whatever you prefer, that's up to you, right? I'm just here to teach, right? What is best for 99% of people out there is buy term and invest the difference.
Yeah.
Because every single time you come across it, and I'll sit down and I'll break policies apart, I'll review them, I'll show them the differences. It never makes sense. Never makes sense to not have buy term and invest the difference if you do it at the right time. Right. Sometimes you could say, hey, I got the whole life when I was 22. Now I'm 64. I have diabetes and cancer. It's going to be so. It's that was just prepared wrong 40 years ago.
Mm-hmm.
Nothing we can do at that point. But sometimes you can 30 years later.
Right.
But it's buy term, invest the difference and then the question comes down to is, well, then I don't have insurance later. But if you're doing things right and investing properly and following the things that you guys teach, right, you don't need insurance your whole life. Right? Fast forward 35 years from now, I have a few $1 million saved up, and you know what? If I can actually bring up an example, and I'll show you because what I did is, you were talking about before, is what is a Roth IRA, right? And it's just investing. I'm big proponents of investing into Roth IRAs. Why?
I love that. We say it all the time on the channel.
Yep.
Perfect, right? So a Roth IRA. Why? I like not paying taxes, right? Anybody for not paying taxes, right? So
For that.
I'll pay the little bit of tax now to save long-term tax-free growth.
My guy.
Right?
Yeah.
Life insurance policies, they market it as tax-free growth. It's not tax-free growth, right? What it is when you pay more into a policy than what the cash value grows to, if you pay more to something and you don't get as much back, that's not a profit. You don't pay taxes on a profit, right? If you're in business and you don't make a profit, you don't pay taxes.
That's the whole point.
Right?
That's really why that's why you report negative sometimes, so you can get the gains on that.
Exactly. So what a Roth IRA is really the only true tax-free growth opportunity because you've paid the taxes already. Right? Now, because it's such a great thing, the IRS controls and doesn't let us do more than $6,000 a year, right? $12,000 if you're married, right? So you could do, even if your spouse doesn't work, you could both still max out a Roth IRA. After age 50, you can go from $6,000 to $7,000. But if you maxed out and we were talking about the S&P, right? You could talk about ETFs, mutual funds, whatever that is, and let's just say an average 10%. And what I did is I said, I thought you were 25 yesterday.
26.
26. All right. So I went to 25, and I made you a year younger. Right?
Thank you. I appreciate it.
Knees-
I'm only
knees-
22, actually.
There you go.
Yeah.
All right, 22 with the beard. That's perfect. Right. So if you were 25 years old and you put away 25, and you put away for 40 years, $500 a month. Now you could get term insurance for 30 years and then get another 10 year after if you wanted protection. So let's say you go 40 years from now investing. Just like what you guys teach, get over 10%, right? Well, if you see here, doing $500 a month, even with the small charges and fees and everything that comes with that, all right, and this is an actual hypothetical, and I'm going to scroll all the way down to when we're 65, you actually now at that point have about $4.5 million,
Jesus.
right? That's investing $500 a month, so not even maxing out a Roth IRA after you're age 50.
Right, you just stopped. You just continued. Actually, they're doing the 6,000.
Correct.
Yeah.
Right. That you'll never accumulate that much wealth. Right. We were talking about building generational wealth. You'll never accumulate that much wealth in a whole life insurance policy or a universal life insurance policy. Now, the universal, because why? It'll start eating at the cash value to pay the difference of the cost of insurance, because it's the cost of insurance that they get you on, right? And they put that in the contract, and you can see there later. But now, let's say now you want to start living off your money. If I have $4.5 million saved up, if you have $4.5 million, and you passed away with no life insurance, Is your family okay with $4.5 million?
They better be.
Yeah.
Right?
For sure. Because you have other assets too. Like that's the thing. I think when we say invest the difference, right? I know you and I speak on this all the time, but do you agree that essentially when you say invest the difference, the older you get, hopefully you're making more money, right?
Yep.
So yes, you can invest the difference in the stock market, but it doesn't mean you can stop there. Like you can max out your IRA. If you have other money left aside, you can also invest in different things. Like maybe you have, after a certain point, you could buy a house.
Yep.
Right, and that could be worth value that you could pass down to your family.
Correct.
So that's another thing I just wanted to add on.
Yeah, no, you're 100% right, because let's say you buy a house at age 30, you're done paying it off at age 60.
Mm-hmm.
Okay, well now your kids are probably grown, right? Like in 30 years, my son's going to be 31.
Mm-hmm.
I hope he's not relying on my income anymore, right?
Right.
My house will be paid off, right? We've saved up a ton of money. We're either retired or just having a business that has a residual income. If I pass away, my wife is okay. The house is paid off. She's got a ton of money saved up in the investments. She's actually better off, right? Because there's two people spending money, now there's only one. Right? So at that point, why continue to pay for life insurance? Because what if I live to 95? I paid life insurance all those years and never used it.
Mm-hmm.
That's so true.
Yeah.
Right?
Yeah.
My fault. I didn't want to cut you off.
No.
I'm just saying, like, that's literally my favorite part about this, everybody. Like, the fact that I'm pretty much guaranteeing, by getting term and invested difference, I'm pretty much guaranteeing wealth for my family. Why? Because if I'm investing from now for the rest of my life, we're always going to be wanting to invest, even if you take it out. But anyways, let's say I invest from now for the next 30 years. I'm getting millions, as we just demonstrated. I'm also covered if I happen to pass away in those first 30 years. I'm also covered for my family's getting, let's say, $1 million policy. So my family is going to be millionaires whether I die early or if I die late.
Both, right? They're going to get the $1 million policy and whatever's their investments.
And
not because they're separate.
Right, exactly.
Just like your car insurance is separate from your money.
Right.
Just like your homeowner's insurance is separate from your money.
Right.
Your life insurance should be separate from your money.
Right.
That's so true, because that's facts. Let's say I die 20 years into my term life, right? They're gonna get the term life money, and they're gonna get my 20-year investments.
Yep.
And especially with back talk knowledge, my investment portfolio will be crazy. I don't want to get
God
no girl that's gonna kill me on purpose.
Nah, God willing, honestly.
No, but you're 100% right, and that's why I teach people to separate, because you want to be in control of them. Right? And listen, it might be, I don't know, I always joke around, well, listen, if we won the lotto tomorrow, would I even need life insurance tomorrow? Probably not. Now, I would still have it maybe, just to take care of it, because I'd maybe investing, maybe do some other businesses, whatever it is. Yeah. But if you had $10 million in your bank account tomorrow, would your spouse be okay without life insurance?
Absolutely.
Right? And now the way that they say, oh, I want to leave my family something, right? Going back to the example here in the Roth IRA, well, when you pass away, that Roth IRA is still tax-free to your family, still tax-free to your children, right? And here, if you see, not only here, because you guys know investments, right? It's not just about growing wealth; it's about maintaining the wealth,
preserving
right?
it,
Preserving it, 100%. So what I did is I showed you, well, what if after you got to that $4.5 million, after you grew that money 40 years later, if you started taking 10 grand out a month to live off of, right? Because it's not, you want to use the money that you saved and enjoy life, right? So you start taking out over $120,000 a year. Even then, if you go another 20 years from now, because that money's still growing. And then if I passed away at age 87, so 22 years later, I'm taking out $10,000 a month for the next 22 years. I'd still leave my family $15.3 million.
Nah, that's crazy.
Wait, hold on. Can y'all please comment, subscribe to this? Because I swear to God, that was a gem. That's actually amazing. The fact that you came so prepared, because... I actually really appreciate it. Thank you.
Of course.
This is amazing, because to put that into perspective, because numbers, as you said, don't lie. Before we started this, right, we were just talking about different things do numbers lie? How does it make sense? But you just kind of broke it down. It was very well said.
Yeah. Thank you. Listen, but it's everything you guys teach all the time, and right, I've watched your videos, and we've chatted over time. It's applying the knowledge. And it's not getting sold, and that's why I love what you guys do, because you're not selling, you're educating.
Yeah.
Right? And hey, I'm here, you're here to educate, right? Bag talk, right? They're here to educate you so you can come back, ask questions, learn, because listen, we're all learning, right? That's what life is. Unfortunately, we don't learn these things in school, right? And that's why there's businesses that make profits off of that stuff, right? Banks make money off our money. Why? Because they understand the rules. Right, life insurance make money off of us, right?
Right.
Yeah.
The goal is not to give life insurance money people, not life insurance people, but life insurance agents all of our money. I want my money.
Right.
I want to be in control of it.
Right.
I'm just giving them some of it in case I pass tomorrow,
Yeah.
in case I pass too soon. But I want to pay as little as possible for as much coverage as my family needs, nothing more, nothing less.
Gotcha.
And invest every other dollar so I can go and do what I want, be in control, right? You talked about the Roth IRA, right? Roth IRA, you can take your contributions from that after 5 years at no penalty.
Yep.
Yeah.
So why would I pay them 6 to 8% to borrow my money when I have my own money here that I don't have to pay back 6 to 8%?
You can use that to buy your first house if you want to. You can use it for your kids' education.
Yep.
There's so many different benefits that people don't speak about.
Yep.
But I just want to make it super clear for you guys, right? So if, and correct me if I'm wrong here, but for whole life, that's only for the people that literally do not invest. Like they're not saving their money, they're not investing their money. That's the only time you go there,
Yep.
right? But if you follow the channel, you're doing what you have to do, you would do term and always invest the difference.
100%.
Simple as that.
100%. And whole life is a very simple product, and it's easily sold because it's very simple, right? This is what you pay, this is what you get. Right,
Yeah.
there's no investing. Oh, the market could be down, the market could be up. It's just a very simple, easy product. It is just not what's in best interest to the client.
Got it.
And I want to put it in perspective, by the way, for people who are now thinking about getting into term. I've been quoted at term from just talking to other agents that I know, just like at like $30 a month. Like that's nothing for insurance, for a life insurance where I'm paying $30 a month to where I can pass down $1 million or however much it was. I'm just saying, like, I don't really remember the policy. I'm just, whether it's $1 million, 100,000, whatever,
Yep.
$30 a month is nothing. So it's just like, if you're thinking about doing term, don't think it's like super expensive if you're healthy, young, etc. Obviously prices vary, but
Sure.
I just want to put it in perspective for some people. Like there's really low numbers you could pay per month to where you almost won't even feel it coming out your pocket, depending on your circumstance.
Yeah, and to that point is, it benefits when we are young, right? Going back to the questions earlier, is when should I get it? And there's always gray area, but if somebody depends on your income, if you have student loans, but if you just want to say, hey, I want to get it because you brought up, listen, we never know what our health status is. We never know if we can get cancer. Now all of a sudden we can't get coverage. I could be 23, healthy as anything, 24, have cancer,
Yeah.
and now I can't get insurance,
Right.
right? And I might be getting married at 27, and now that's it, right? So if you want to just make sure you're protected, yeah, get a policy, get that low locked-in rate, right? Get a cheap term, get a cheap policy, save your money, and hope you never use it.
Right.
But at least guarantee that you're getting that low rate when you're healthy, saved in just in case something happens.
This
Yeah.
is amazing right now.
Yeah, and I want to actually go ahead. Tell
You want to
them.
do it back?
Yeah,
Yeah. All right.
yeah.
So basically, and he has no idea what's happening right now. So this is like as organic as you can possibly get, right? But basically, as you guys know, whenever we bring on a guest, we always give them the option to basically say, give us bag talk. Literally, give us a piece of advice, essentially, that you want to like summarize everything, and it's like that one special gem that you have, right? So, what is a piece of bag talk that you want to give to our audience?
Sure. So I guess you get, like a big thing for me, right? Coming from kind of the service that, I was a soccer coach and I never thought to get into this industry. That really wasn't, it was always, I went to school for psychology. My goal was always to help people and get them through, hard times. My goal is to help the millions of people become millionaires, not help the already millionaires, just preserve their millions. Now, doesn't mean I turn away millionaires, right? I'm not saying that. But they have, they get these calls from, high net worth companies, that are calling them every single day. Hey, give me your $5 million. I'll teach you this, whatever. But it's the everyday people that are on YouTube. Hey, I want to learn, and I only have $25 a month that I can invest, that need these concepts, need the rules there. So the biggest piece of advice I could say is, one, educate yourself. Nothing, and that's coming from someone that used to sit in the back of the room at class, couldn't care less about what they were teaching up there, was doodling, doing all that. But educate yourself, because nobody's going to care more about your money than you.
Yeah.
Right? No matter how much we're talking here, and you guys care about all your followers' money, they care even more as well, right? So educate yourself and validate what we're saying, right?
Yeah.
Learn for yourself that way. And when it comes to investing, I think you guys can say this, right? Diversification, discipline, and I think dollar cost averaging is something you might have talked about a while back as well.
Absolutely. Absolutely.
Every day.
And it's crazy. I'm going to tell you right now, we did not like have this conversation. But everything he just said, I know y'all hear us talking about all the time. So it's just funny.
Yeah.
Yeah, it's so important because it's not get rich quick. It's right. We're here to teach people how to build wealth and then pass that generational wealth on, right? And because if we become wealthy in our families, nobody will ever have to worry unless we have some like great grandchild that ruins it all, right? but if we teach and everybody learns that, right? If you hand your children $15 million, it's going to be hard to mess that up, especially if it's tax free. Mm-hmm. Right?
Yeah, sure.
So if we do it and follow, right, practice what you preach, right, and do that, then everybody will be good.
That's fire.
We passing wealth, we passing knowledge. Joe, we appreciate you. You want to please give the people like how can they reach you? Like how can they get in touch? How would you help them?
Sure. So if you wanted to email me, keep it real simple. It's jcatanzarite2@gmail.com. So I'll have spelling for that for you later on that. I am on Instagram and Facebook. I am nowhere near as great as you guys are.
He's new to it.
Yeah, I am definitely new to the social media game, but we are on Instagram. It's all.about.the.benjamins21. Right, so that is our Instagram, all about the Benjamins 21 with dots in between all that. You could follow us there. Feel free to reach out. I'm always open to review what you got, answer questions. Never feel like you're going to get sold something. I want to educate, make sure you're making the right decision for yourself. And make sure that we can put people in the right direction.
I appreciate it.
And one thing I want you to say is because all about the Benjamins, there's a little backstory. You can say that briefly before we close.
Yes, so my son's name is Benjamin, right? That is not why we named him that.
I was gonna say that's a fire name for like Benjamin.
Yeah, so that is my son's name. His name is Benjamin. So that's where that backstory comes from. I forgot we were talking about that months ago. So that's where it came from, right? We want to teach people, hey, save those Benjamins, right? Make money, right? But also everything we do here is for my family, for my son and my wife. So
that's fire.
That's
so nice.
That's wavy.
All right, so that's all. Please make sure you guys got all that information. We're gonna put it on screen for you guys as well, in the description as well. So contact him if you have any questions whatsoever. I learned a lot. I'm sure you learned a lot, and I'm sure you guys learned a lot. So thank you. Make sure you guys like, comment, subscribe to the channel. Hit that little notification bell because we drop
2 videos a week.
And you don't want to miss them. If you have any questions, you know what to do. But until then, peace.
Peace.